Hello and welcome to BQ Prime. You're watching IPO Adda, and the company in focus today is Kaynes Technologies. The company is coming out with an IPO which opens on November 10th and closes on November 14th. Price between 559 and 587 a share. It's raising nearly 530 odd crores in fresh issue and 327.8 crores in offer for sale. Company is valued at nearly 3,400 crores at the upper end of the price band. And joining me is Miss Savitha Ramesh, who is the chairperson of the company, Mr. Ramesh Kunhikannan, who is the MD, and Jairam Sampath, who is the CFO of the company. Gentlemen and ma'am, thank you very much for joining us on BQ Prime. Let me start with you, ma'am. Can you take us through what is this 530 crores you're raising through a fresh issue going to be used for?
Yeah, this we are going to use for 250 crores will be on the capex, which we are going to deploy in our existing facilities of Mysore and Manasar, and the 150 crore will be on a new facility which is going to come up in Chamarajanagar, which is close to Mysore, and 130 crores will be used for repayment of the current debt that we are having, and about 140 crores is going to be used for long-term working capital, and the balance is going to be used on corporate funds, which we will be deciding to be used in the subsidiaries that we are having. That is the IoT solutions business, development of US market, etc.
Mr. Kunhikannan, can you take us through, Ms. Ramesh spoke about some of the brief, objects of the issue, but I think a large part of it is going to be used for some of your subsidies and capex requirements and expanding your manufacturing base. What kind of facility is this, and which areas will it be related to?
These are all going to be expansion in capacity building for increasing our sales. So, and we are going to put up larger facilities because China +1 will be the concentration. So people are used to seeing larger volumes. So we'll be putting larger facilities. And this money will be completely used for that.
Mr. Sampath, what is the kind of debt that you have on your books on a gross level and a net level, and how much will it come down to after the repayments?
Yeah, so fund-based debt on our books is about 180 crores, and post-repayment is likely to come down to about 50 crores. And going forward, also there will be generation of cash within the company, so we may not have too much of significant debt going forward.
What about the working capital requirement? Because I'm assuming that there's a huge working capital requirement, because in Q1 we saw your operating cash flows to be negative. How do you explain that, and whether you see that to turn positive in the remainder of the year?
Yes, it will turn positive, given that we already have orders on hand, and as we declared in our prospectus also, we got sufficient orders to meet this year's plan, and we are also raising funds in this IPO. About 130 crores will pay back the debt. So as far as working capital requirement is concerned, there have been a steady improvement over the last 3 years, and net working capital stands in 2-digit right now at FY22. It's about 98 days or so. And we also have some 2-3 plans in mind, so that we, in terms of number of days of sale, we are going to reduce the working capital. And moreover, the kind of scaling that we have witnessed for last 2 years, and even the first quarter, if we were to compare proportionately compared to last year, it's at about 67 to 70% of growth is there. With this growth, very shortly, if this growth were to continue, very shortly we will also start bringing in more cash, and then also to fuel both the working capital requirements of the company, and also a little bit of margin money for additional capexes as and when we require it in the future.
Mr. Kunhikannan, the order book is roughly around 2,266 crores for you. Your full year revenue last year was 706 odd crores. Can you give us a perspective on what is the tenure of this order book? By when do you have to fulfill this order book?
In the next 1.5 years, we need to complete this, because every month we are receiving newer orders and the billing has happened. So we are closer to 90% of last year's billing of 706 already in the 7 months. So this year, on completion, we will have a opening order book of around similar numbers.
Okay. And where is this order book coming from, Ms. Ramesh?
We have a diversified business: railway, defense, aerospace,
Hmm.
automobile, industrial. So we have from all the sectors on the similar percentage, plus minus of 2 to 3%.
Mm-hmm.
Top
Ms.
three
Ramesh?
sectors being-
Yeah.
Top three sectors being automotive, industrial, and railways.
Okay. Mr. Ramesh, give me a perspective on this China Plus One strategy, uh, especially in the last 2 to 3 years, 2 years especially, we have seen the semiconductor issue which has impacted automobiles. How many of the Indian players have adopted China Plus One, and how many of them have come to you?
All of them are on a real push and a rush on getting there faster. But because of the semiconductor non-availability, it is going little slow. However, all efforts are being made to get allocation done and then being met. I would say that from various global players on their China's facility, they are in working very hard, recruiting more and more people to localize and indigenize it faster.
Give me a perspective on it with respect to in the last 18 months, how
We Kaynes has seen around 8 to 10 players coming in.
and today, as part of your total revenue, what percentage of your revenue is coming from domestic market and what percentage is coming from the overseas market?
We are around 78 in domestic and 22 in exports.
Okay. Ms. Ramesh, if you can give me a perspective with respect to the fact that your auto segment has gone up to nearly 41% of your revenues. That's a steep increase that you saw. Is it entirely because of the China Plus One strategy which has come in, or you have seen a lot of domestic players?
Partially it is China Plus One, but partially it is also more and more electronics coming into cars and safety areas. So you will find more and more electronics coming in. So it is not the market alone growing, the opportunity for electronics being replaced by various mechanical and electromechanical positions.
Okay. Give
Also,
me a
the EV coming in has increased the portion of electronics in the automobile sector. So that there also we play a major role.
I was coming to that question only to ask you what percentage of your revenues would in the auto segment be coming from EV?
Currently, we are at about 7%, but we are working with some of the major players in the two-wheeler, in the three-wheeler, and the four-wheeler segment. That we are seeing this to be increasing to about 20% in the future.
Okay. When you say the future is how many years you're talking about?
Another 2 to 3 years.
Okay. To give me a perspective with respect to the entire manufacturing landscape which has evolved in the last 18 odd months because of the semiconductor chip issue and China factor which has come in. Your order book has gone up to nearly 2,200 odd crores, which is to be executed in 18 months. Are you seeing a lot of queries and order flows coming in because of these factors, and is your facilities geared to handle this kind of order book?
Yes, we are seeing a great demand coming in from the various sectors that we are in, and that is the reason that we do not want to lose out on the opportunity, and that is why we are gearing up to increase the capacity and ensure that we grab the orders and we can satisfy the orders.
And is the geographical diversification part of that thing which you have undertaken? Because
Yes.
currently 60%, more than 60% is coming from Mysuru, if I'm not wrong.
Yes, and that is why we are going to also set up a greenfield facility in Chamarajnagar, which is about 400,000 square feet of manufacturing area. So, and that will also include a bit of backward integration in terms of plastic molding, in terms of cable assemblies, box build capacity, and PCB assembly.
Okay. Mr. Sampath, give me a sense of the kind of growth capital requirement that you have over the next 2 to 3 years. You are just seeking some with from the IPO, but will your operation cash flows be sufficient enough to handle that kind of growth which is coming in at a very aggressive pace?
Yes. So with the IPO money that we are raising, we certainly think that almost based on the capacities that we will be developing, and since we don't expect too much change in our profile of business, so we would probably be about, if I may to hazard a guess, the capacity about three times the current number. We will be doing almost tripling an additional capacity, and from FY24 onwards, I think we'll also start generating extra cash, which we will employ for margin money for additional capex if we have to take some term loans, plus working capital, because working capital requirement also will be there. So we expect sufficiently for the current business that we have planned over next 4 years, sufficient amount of funding, and also set it up for the higher growth later on.
Okay. Give me a sense of the margins that you have, because in FY22 you had a margin of 13.3%. In the first quarter, we saw a margin pressure coming in at and bringing down the margin to 12.3% there for you.
Yeah.
How do you see that margin pressure going, given the fact that you have higher energy cost, semiconductor issues remains a concern, and labor cost is also going up?
Primary reason why there is a temporary dip in the quarterly margins that you see is because the first quarter typically is about 16% of the total year. So the total overhead absorption is lopsided towards the fourth quarter typically. So as we go forward, we in fact, based on the actual cost profiles and based on the gross margin numbers, I can say that if not better, it will be at least equal to last year's numbers.
So you're saying that there is scope to expand your margins beyond 15% in this business?
Yes.
Okay.
Provided we work out our diversification the way we are all growing.
Yes.
Okay. Okay. That caveat is taken. My question was with respect to the seasonality which is there, right? In your RHP, you mentioned that Q4 is the best quarter for you. But what we have seen is that your business segment revenues have tilted towards more of automotive in the last 1 year. It's gone to nearly 41.3% in the June quarter. Do you still see that seasonality coming in Q4?
Yes. See, what is happening is, one is supposing there was not much growth, then seasonality will remain the same, right? 1, 2, 3, 4 is a typical rhythm in which it works. When you superimpose a growth of 67%, 70% types, the seasonality becomes even more, there's a quarter-to-quarter increase in business. So the seasonality gets a little more accentuated, okay? Having said that, some of the businesses like railways, electronic, which is a high margin business for us, and aerospace, etc., they typically happen in the second quarter because some of the export clients end their businesses in December, so there is a pressure there. Some of the domestic clients end their businesses in March for the year, so there is a pressure there. So these two, so typically the second quarter not only is more in terms of revenues, it's also more in terms of margins.
And also more in terms of order flows coming in as well?
Yes. More in terms of order flows coming in too. Because as I mentioned it, and you've also mentioned it yourself, there's a 2,200 crore order, and like Mr. Ramesh mentioned, month on month there's an increase in order too. So that is also, order book is also going at about same 70-80%. So that leads to second half being always more busier, much more busier than the first half.
You said the railways as one of your segments, which has nearly 10% of your revenues today. What kind of work that you do in railways, and do you see as electronification of railways happens more business is coming your way, and do you have any partners through which you work with the railways?
Yeah, we have various partners through which we work in railways. More and more electronics is coming in, but our percentage wise, it will stay around the same number because domestic requirement of other verticals are going up. So percentage wise, there will be no growth, but overall, at the similar percentage, we'll be growing the railway because more and more electronics also is coming into railways.
Mm-hmm.
Currently, we do the railway signaling boards with the safety level 4 integrated boards.
Okay. What about aerospace? Because that's a segment which is very volatile. Last year, 3.5-4%. Now in the first quarter, 0.3%. Why is this volatility coming in the aerospace segment for you and defense?
See, last 2 years, aerospace defense is little low. But in the days to come in, it is the industry is again caught up. It will come up and then we will work on the similar numbers.
Yes, we also
We have orders, but they are not yet started taking deliveries in a big way.
we are under the what is known as the pilot production. So there are some big orders from very reputed
Post-COVID, airlines have not taken delivery of these products.
But we have been qualified by 2 or 3 major customers, and we are in the prototype stage for this. So this should be increasing in the next year.
No, we can expect it to come back to the original percentages shortly.
Okay. What about the consumer segment? Because that's also something which you cater to, and it has nearly 11% of your revenues. What kind of work that you do there, and do you see enough growth coming in the consumer segment for you?
Yeah, we are seeing the consumer segment grow from 10% to about 20% in the next year. This is and in the consumer segment, what we are doing is we are doing only where we are there in the design component also. We do not want to do just the run-of-the-mill consumers segment. We want to do components and products where we have a design component. So mostly in the consumer segment, you will see that our segment is in the ODM, that is original design manufacturer. So we design a part of the product there, and then we have customers to whom we supply these products.
And these are high margin, I assume, because you are ODM for them as well.
Yes, because there is a differentiator between the run-of-the-mill consumer and the ODM consumer, because our design component is there. So the margins are slightly higher than the rest of the consumer.
I was looking at your top customer, and top 5 was accounting for nearly 39%, and top customer was accounting for 12.38%. And if I'm not wrong, the top 10 had a significantly higher share. What are you doing to diversify your customer base?
If you see in the past, we were having the top 10 as 80%. So slowly we are bringing down. Now we are currently at around 50% in the top 10. The days to come in will become 40% on the top 10. See, more and more businesses are growing, more and more businesses are coming in. So diversification is helping us. Having said that, less than 30-40% will be difficult for the top 10 customers.
Okay. Who's the top customer? Because it accounts for nearly 12%.
India Japan Lighting.
Sorry?
India Japan Lighting.
Okay. And what is the kind of revenue projections that you have from them? Because have they been growing every year for you, or it's been constant?
Yeah, without a specific naming we don't have the permission to talk about their business. But yes, in general, the top customers' business is increasing, and we are getting with all our top customers, we are getting opportunities to take care of their export demand too. So we think that
we expect it to grow on a steady state.
And what will happen is we are also getting now contracts with other customers with equally large numbers. So that's how your earlier question of how we plan to reduce the total percentage of the concentration of top customer is because we are going to add some more customers who are equally large. And so with that, what will happen is the largest customer will be less than 10% kind of number. And top 10, like Mr. Ramesh said, maybe at best we can get it to 40%, because we also don't want to lose the opportunity provided by large customers.
Okay. One of the biggest challenges for you is that, semiconductor requirement, which is there, right? If I'm not wrong, you rely on entirely from overseas markets, and 64% of the raw material is semiconductors. What is the kind of, work you're doing to ensure that it's been fully the agreements are there with the suppliers so that there's no disruption, because we saw how semiconductors can disrupt the entire ecosystem in the last 18 months.
No, absolutely. See, I think that is also the reason why if you see our performance in the year FY22, we grew at about 67%, which is industry-best growth in our similar sectors. The secret to this is long-range planning, and that is facilitated by large order book. So today, customers are trusting us with orders which are spanning into the next year too. About 1.5 to 2 years worth of orders we actually have, which helps us to place back-to-back orders on the supply chain and make sure that we get good allocation from, if there are shortage situations, we get good allocation from the suppliers, essentially. That is one way of mitigating. The second way of mitigating is that some of the revenues are coming from things like ODM and so on, wherein we do have some little control on the design and we can always look for alternates. And our engineering capability also helps us to look for alternates in rest of the business too. That way, what we do is we reduce the risk of one item not being there, causing a huge disruption to production. Instead of that, we can always suggest alternatives to our clients and so on, so that we can mitigate that risk.
Give me a perspective on this raw material thing, because I was looking at the raw material part of it, and it mentioned that nearly 35% comes from Singapore, and only 6% comes from China. I assume that it's getting built in Singapore. That's why 34% is coming from Singapore. But what is the origin for those raw materials?
No, it is only built, as you said, it is only built from Singapore, because Singapore is Asia Pacific leading place for electronic components.
Logistics.
But it is manufactured around the globe. Okay. If you see, there are manufacturing of semiconductors in Japan, Taiwan, China. So everything comes in. Thailand is also a good player. Everything comes in into Singapore, and from there it's shipped out.
And so, sir, one of the things that when we say China manufacturing, many of the semiconductors companies are the companies that own those products are American or Taiwanese or Japanese and European, but they may produce it in China. So to that extent, it varies because the technology is owned by those countries. Okay. The second thing is China manufactured components are maybe sub 10% total value, and bulk of it is in the bare PCB area, essentially, wherein China is the largest copper producer and they have large facilities for making bare PCB and some little magnetics here and there. So to that extent, if you desegregate the supply chain, the risk is not that high. But having said all of that, sir, large scale semiconductor manufacturing facilities are in China. So to that extent, the global play does have some impact. So the only way to get over it is to, and we also have observed that these are all not long-term disruption. They all happen for 1 month, 2 months, etc. So in order to get over it, we have to do long-range planning, make sure that orders are there, and make sure that we keep some little stocks of critical parts, so that we don't.
So, which is the country where I'm looking from a supply chain point of view? Which is the country which is more critical to you? Because China is sub 10 for you, but which are the other countries? Vietnam and Thailand and others would be much more than 10%.
US, Japan, and Taiwan, sir.
Taiwan.
Taiwan
all of them
is
will be
equally important.
Equally important country.
So all of them would be more than 10% for you in that sense?
Yes,
Yes.
Around that.
From a supply chain point of view, basically.
Yes, 62% is 60% of our purchases are imported, and so in that, let's say about that's about 42% total. In 42%, 10% is China design, China manufacture. Remaining are some could be manufactured in China, but the remaining are equally split among all the other countries in terms of design ownership.
As you see for going forward, how do you see this electronic ecosystem emerging in India, Mr. Kunhikannan?
Various government schemes have come in. So I feel next 3 to 4 years, the entire ecosystem should be back in India, which China has taken around 8-10 years to build. But we also see the Chinese route people are taking in, the Taiwanese route, but the entire ecosystem will be set in 3 to 4 years.
Are you participating in any of the PLI schemes?
We are already awarded 2 PLI, 1 or 2 is pending on the telecom PLI as well as on the white goods air conditioning equipment PLI. We have got the sanction.
What is the kind of timeline that you have of when you start, how much you have to invest there, and by when you start seeing?
We have promised to do around 50 crores in both the PLIs, which we'll be doing, and that is there for next 5 to 6 years.
And which is the other 2 which you have applied for?
We have applied for 2 more, one on the automobile side, one on the IT side.
Okay, and that's expected as and when the government announces.
Yeah.
And again, the investment will be similar amount?
Yeah, similar way.
Where is it going to be built? Because you have to build fresh capacities for that.
We have applied some in Manasar, some in Mysore, like that.
Okay. So over a period of time, in the next 3 to 4 years, do you see a large portion of that coming in through PLI-based revenues for you?
Yes, I am expecting that also to add into our bottom line.
And the margins will be higher there for you, or is this getting a hyper competitive market as well? Because everyone,
Yeah, I think it will become a hyper competitive market. Margins will stay in the similar fashion.
okay, gentlemen and ma'am, thank you very much for joining us on BQ Prime today. The Kaynes Technologies IPO opens on November 10th and ends opens on November 10th and opens on November closes on November 14th. Price between 559 to 587 per share, with fresh issue of 530 odd crores and offers of 327.8 crores. Thank you very much for joining us on BQ Prime.
Thank you very much.
Thank
to
you very
BQ
much.
team.
Thank you, Vicky.